Fuzzy insurance. Fuzzy set theory is a recently developed field of mathematics that introduces set of objects whose boundaries are not sharply defined. Whereas in ordinary Boolean algebra, an element is either contained or not contained in a given set, in fuzzy set theory the transition between membership and non-membership is gradual. The theory aims at modelizing situations described in vague or imprecise terms, or situations that are too complex or ill-defined to be analyzed by conventional methods. This paper aims at presenting the basic concept of the theory in an insurance framework. First, the basic definition of fuzzy logic are presented and applied to provide a flexible definition of a preferred policyholder in life insurance. Next, fuzzy decision-making procedures are illustrated by a reinsurance application, and the theory of fuzzy numbers is extended to define fuzzy insurance premiums. In 1965, ZADEH published a paper entitled Fuzzy Stat in a little-known journal, Information and Control, introducing for the first time set of objects whose boundaries are not sharply defined. This paper gave rise to an enormous interest among researchers and initiated the fulgurant growth of a new discipline of mathematics, fuzzy set theory. The number of papers related to the field exploded from 240 in 1975. And there are many more researchers in fuzzy set theory than in actuarial science, and they form a much more international group with important contribution from China, Japan, and the Soviet Union. Two monthly scientific journals publish new theoretical development and application that are to be found in linguistic, risk analysis, artificial intelligence, approximate reasoning, expert system, pattern analysis and classification, pattern recognition, clustering, image processing, computer vision, information processing, and decision making. In this paper, we will explore some possible application of fuzzy set theory to insurance in ordinary Boolean algebra. An element is either contained or not contained in a given set. The transition from membership to non-membership is abrupt. Fuzzy set, on the other hand, describes set of elements or variables whose limits are ill-defined or imprecise. The transition between membership and non-membership is gradual. An element can more or less belong to a set. Consider, for instance, the set of young drivers. In Boolean algebra, it is assumed that any individual either belongs or doesn't belong to the set of young drivers. This implies that the individual will move from the category of young drivers to the complementary set of not young drivers overnight. Fuzzy set theory allows for grades of membership depending on the specific application. One might, for instance, decide that drivers under 20 are definitely young, that drivers over 30 are definitely not young, and that a 23 years old driver is more or less young, or it is young with a grade membership of 0.7 on a scale from 0 to 1. Fuzzy set theory thus aims at modelizing imprecise, vague, fuzzy information which abound in real-world situations. Indeed, many practical problems are extremely complex and ill-designed, hence difficult to modelize with precision. To quote Zade, as the complexity of a system increases, our ability to make precise and yet significant statements about its behavior diminishes until a threshold is reached beyond which precision and significance become almost exclusive characteristics. Computers cannot adequately handle such problems because machine intelligence still employs sequential logic. The superiority of the human brain results from its capacity of handling fuzzy statement and decision by adding to logic parallel and simultaneous information sources and thinking process, and by filtering and selecting only those that are useful and relevant to its purposes. The human brain has many more thinking processes available and has developed a far greater filtering capacity than the machine. A group of individuals is able to resolve the command tall people in the back, short people in the front. A machine is not fuzzy. Set theory explicitly introduced vagueness in the reasoning, hoping to provide decision-making procedures that are closer the way the human brain performs. A clear distinction has to be made between fuzzy set and probability theory. Uncertainty should not be confused with imprecision. Probabilities are primarily intended to represent a degree of knowledge about real entities, while the degree of membership defining the strength of participation of an entity in a class are the representation of the degree by which a proposition is partially true. Probability concepts are derived from consideration about the uncertainty of proposition about the real world. Fuzzy concepts are closely related to the multivariate logic treatment of issues of imprecision in the definition of entities. Hence, fuzzy set theory provides a better framework than probability theory for modeling problems that have some inherent imprecision. The traditional approach to risk analysis, for instance, is based on the premise that probability theory provides the necessary and sufficient tools for dealing with the uncertainty and imprecision which underline the concept of risk in decision analysis. The theory of fuzzy set calls into question the validity of this premise. It doesn't equate imprecision with randomness. It suggests that much of the uncertainty which is intrinsic in risk analysis is rooted in the fuzziness of the information which is resident in the database and in the imprecision of the underlying probabilities. Classical probability theory has its effectiveness limited when dealing with problems in which some of the principal sources of uncertainty are non-statistical in nature. In the sequel, we will present the basic principles of fuzzy logic, fuzzy decision making, and fuzzy arithmetic while developing three insurance examples. We will show that fuzzy set theory could provide decision procedures that are much more flexible than those originating from conventional set theory. Indeed, insurance executives and actuaries, much better trained to deal with uncertainty than with vagueness, have often transformed imprecise statements into all or nothing rules. For instance, Belgian insurers have used the fuzzy statistical evidence young drivers provoke more automobile accidents to set up the posteriori rating rule. Drivers under 23 years of age will pay a $150 deductible if they provoke an accident. Hence, young was equated with under 23, a definite distortion of the initial statement. As another example, Belgian regulatory authorities define for statistical purposes a severely wounded person as any person wounded in an automobile accident whose condition requires a hospital stay longer than 24 hours, a very arguable defuzzification of a fuzzy health condition. In section 2, we will present the basic definition of fuzzy logic and apply them to provide a more flexible definition of a preferred policyholder than the one currently used by some American life insurers. Section 3 introduces the main concept of fuzzy decision making and uses them to select an optimal excess of loss retention. Thank you.